Welcome back to our channel, where we break down complex financial concepts into simple, actionable insights. Today, we're exploring the difference between active and passive management in the world of investing. Active management involves mutual fund managers actively choosing and handling investments in an attempt to beat the market. This approach usually comes with higher fees because managers are compensated for their expertise and research. But it can potentially yield higher returns if the manager's investment strategy proves successful. On the flip side, passive management involves investing in a fund that tracks a specific market index, like the S&P 500. Passive strategies generally come with lower fees as there's minimal active decision-making involved. However, while passive funds offer cost efficiency, they might have less potential for high returns compared to actively managed funds since they simply replicate the performance of the tracked index. In summary, active management involves hands-on investment decisions with potential for higher returns but higher fees, while passive management follows an index with lower fees but potentially limited returns. Thanks for watching. Understanding the differences between active and passive management can guide your investment choices. Don't forget to like and subscribe for more financial insights.
निवेश बाजार जोखिम के अधीन है। योजना से संबंधित सभी दस्तावेज सावधानी से पढ़ें। यह वीडियो केवल शैक्षिक उद्देश्य के लिए है। कृपया अपने वित्तीय सलाहकार से परामर्श लें कोई भी निर्णय लेने से पहले।